Going to get started now. As usual, what we're doing today is our multi-method investing financial markets update. All right, so what I'm going to do is start with, as usual, just a recap as to what has happened in various areas of the financial markets year to date in 2025. So Mick, if you could just kind of zoom in on this area over here. Just really briefly, this data is as of August 18th, so the close of business on Monday. So it's changed a little bit since then. The market has come off, a little less than 1% since the close of business that date. But these numbers are still pretty close to what you see here. So we'll start off with world stock. Right, so world stock, here we're using the FTSE Global All Cap Index, which includes not just US stocks, not just large, mid, and small cap stocks, but also international developed and emerging market stocks, also large, mid, and small cap in those areas. So it's the broadest measure of the stock markets, right, worldwide. And so that metric year to date is a positive 14.46%. Right? Then, if we look at a more granular level, you have U.S. large cap stocks as measured by the S&P 500 up 10.54%. So just peaking into double digits there, just over the last week or so. Then going down the line, we have U.S. mid cap stocks up 2.86%, so a pretty significant difference between large cap and mid cap, and then an even greater difference between large cap and small caps. U.S. small cap stocks are up only 0.24%, and that was as of Monday, and now stocks have come off a little bit, so now we're probably in the negative on small caps if we were to remeasure that as of, let's say tomorrow morning. Then we have international developed market stocks, and here we're using the MSCI EAFE index. This is the best performing index year to date, or broad asset class year to date, up 23.12%. Similarly, and that's been the case for pretty much the whole year running. We can go into that in a little bit as to why that might be the case. Then we have emerging market stocks have recently very much caught up with international developed market stocks, are up 20.49%, right? Emerging market stocks being all those stocks that have an investable exchange but do not fall into Western Europe, Canada, Australia, New Zealand, South Korea, Japan, etc. Basically anybody else out there that is an international market that has an investable exchange would fall in the emerging markets category for the most part. You also have something called the frontier markets that could fall in there, but typically that's considered a separate category. But emerging markets doing very well, along with the broader international developed markets. U.S. short-term bonds, here we're using the Bloomberg Barclays 1 to 5 year aggregate bond index, which includes corporates, treasuries, agencies of shorter maturity, so 1 to 5 years, is up 4.14%. Similarly, the U.S. aggregate bond index, again, Bloomberg U.S. aggregate bond index includes corporates, treasuries, agencies, but of all maturities, right? So not just short-term, but also intermediate and long-term, going out 20, 30 years even, right? That is up 4.31%. So not a big difference in returns between short-term and the broader aggregate index on the bond side. And this is U.S. bonds, right? Then we have TIPS, Treasury Inflation Protected Securities, up 5.21%. So as far as bonds go, in the United States anyway, TIPS have done the best. If you go outside the United States, you could also look at emerging markets bonds, etc., who have done even better. But within the U.S., bonds categories and TIPS are up 5.21%. So pretty much everything is now back in the black, so to speak, except for, again, with, small cap has probably peaked back into negative territory over the course of the last few days. And this is even after what I'm going to talk about in a few minutes, which is the recent mini bear market that we just went through. So I'll talk about that in a few minutes. So before I get there, though, just I'd like to point out the significant difference in returns that I think everybody recognizes just from what I just said between U.S. stocks versus international stocks. And a lot of this difference doesn't have to do with the actual performance of the stocks in those markets. It has more to do with currency. All right, so it has more to do with the dollar versus other currencies, in particular the euro and other currencies out there. So the dollar has weakened very substantially over that time period relative to other currencies. What has also happened, and a further potential explanation for this is, investor, market participant expectations for growth in the U.S. versus outside of the U.S. In the intermediate to long term, possibly due to concerns about tariffs. There could be other concerns as well, but most of this can be attributed to weakness in the dollar versus other currencies. Because if you were to look at the returns, I was just in Germany for about 3 weeks, a little over 3 weeks, and if you look at returns on stocks in Germany, in euros, they're not nearly as impressive here as they look in the U.S. because of the weakening dollar, right, or the weakened dollar. So that's a big part of that. Now, part of the question is we can get into later also is, why is the dollar weakening? That's a much bigger conversation, and there are a lot of factors that go into play there that we can talk about. Okay, so that's where we started year to date in 2025. We're a little over 8 months in. Since this is just from January 1st until now, so it's kind of an arbitrary time period, but people like to look at it from that standpoint. So making kind of scroll over this way a little bit, let's take a step back and look at the markets going back further, because a lot has happened over the course of the last couple of years, right, in a very short time span. So you may need to zoom in a little bit here as necessary, right? So let's go back to January 4th of 2022, all the way back to there. This was the peak of, let's see, this is two bull markets ago, right? Was the prior record peak of the post-COVID bull market, right? January 4th of 2022. We then went into a bear market that lasted until October 13th of 2022, a bear market being defined as a cumulative decline of 20% or greater from a record peak, right? We achieved that somewhere around here, but the trough was on October 13th of 2022. We then recognized that we had re-entered a bull market on January 19th of 2024. We knew we were in a bull market at that point, because at that point we had re-achieved the prior record from January 4th of 2022. In the meantime, however, we had a correction of 10% or greater plus a recovery. So we define that as something we call a wolf market. That's just our term from an environment where you've got a heightened volatility with no real clear bull or bear trend, and quantitatively it's a period of decline or 10% or greater, but not 20%, not more than 20%, right? Plus the recovery back to the prior peak. So that happened during this time period from July of 2023 to December of 2023. Shortly thereafter, on January 19th, we recognized, okay, we have been in a bull market since October 13th of 2022, and that's when we knew we had a trough at that point, right? Okay, what happened since then? So then we went into something called an eagle market, right? An eagle market we define as an environment where you've got a low volatility on the marketplace, rapidly rising or soaring asset prices, hence the name eagle, and quantitatively we define that as a period of trailing returns of 30% or greater without any 10% plus, intervening 10% plus correction. So we recognized somewhere around here that we hit that threshold. All right, so we recognized we were in an eagle market, and it turns out that eagle market lasted until December 23rd of 2024. At that point, returns started to taper off and dropped below the 30% trailing return number, down 29, 28, etc., and then it got lower and lower. On February 19th of 2025, we reached a peak, right? But we didn't necessarily know that that was a peak from the standpoint of considering whether the ensuing time period was a wolf or a bear market until later. Because you never know what type of market environment you're experiencing at any given time until after it already happens. You know in arrears once it has been confirmed quantitatively. All right, so on February 19th of 2025, we reached what appeared to be a peak. We then, on March 11th of 2025, so very shortly thereafter, we hit a 10% plus correction. At this point, it was unclear whether this was going to be a shorter term wolf market where we would have a 10% or greater but not 20% correction and then return back to the prior records, which was kind of the expectation at that point. If you look at history, that was the most likely outcome. Turns out that's not what happened. It was a less likely outcome happened, which is what we dropped down on April 7th of 2025. We broke through the 20% cumulative decline threshold to achieve a bear market. So on that date, April 7th, we confirmed a bear market. Now, what's interesting was the bear market threshold was breached only on an intraday basis, right, but not on a closing price basis. So this is interesting because if we had done the same analysis 5 years ago, and we used to do this analysis on a closing price basis only before we were able to up our analytical capabilities and our technology to use an intraday approach as well. So now looking at this on an intraday basis, this is considered a bear market from our perspective. Now you didn't really hear about this much on the news because most people are using the closing price basis to determine whether something is a bear market. So if you looked in the news over this time period, there was not a lot of people talking about, a lot of pundits talking about a bear market that was confirmed. But from our perspective, it was confirmed. It actually was not. We didn't know this was a bear market, right? And until June 27th of 2025. Again, you don't know until you only know in arrears, because that is the point at which the February 19th of 2025 prior record was reachieved. So at that point, we knew we dropped exactly 21.35%. And on exactly the same day that the 20% threshold was breached, we hit the 21.35. We knew on June 27th that was actually the same day as the trough. So it was indicated and troughed on exactly the same day. This has happened repeatedly in the past. If you look at the history of markets since 1950, this is, I wouldn't say it's a common occurrence, but it has happened enough times to be a thing, right? It's something to watch for. And actually, there's about, roughly 50%, give or take, of bear markets actually turn around within the first month to 3 months after they're indicated. Some as early as the same day, as was the case here, right? It indicated and turned around on exactly the same day. Which you see here, bear indicated, bear trough, right? Okay, so actually the last time we did this session, this video session that we're doing right now, was I think on June 25th. And if you recall, anybody recalls who goes back and watches the video from that day, we were talking about what's going to happen in the next couple days, what's going to happen today. And it turns out that 2 days later, we re-achieved that prior record peak. Okay, so that was interesting. So now we know that we have been in a bull market, a new bull market, since April 7th of 2025, right? And so far, this bull market has lasted up through at least Monday, right? At least through Monday, right? We've seen a little bit of fall off since then. And as of today, right now, the duration of the bull market up through today, if we assume the bull market has continued up through today, has been 4.5 months with a cumulative gain of 32.28% since the trough here, right? But what's more important from a predictive and predictive analytics standpoint is what has happened since the indication of the bull market, which happened on June 27th. So since then, it's been an additional 54 days, right, since June 27th, and we've had an additional gain of 4.04%. And this is as of close of business yesterday. As of Monday, it was a little bit higher. It was like 4.9%, right? So that's like the max gain we've seen so far since that time period. Okay, so that's kind of where we stand. That's what has happened. Oh, just going back, will be of interest in a few minutes. The bull market, the prior bull market, the one we're currently in, the one that ended on February 19th of 2025, it lasted 2.35 years and had a total cumulative gain of 76.06%. That's interesting because, actually, if you move over here, Mick, so if you look at the history of markets since 1950, which is something we analyze, we're actually going through a reanalysis right now to include the last 5 years of data in our analytical framework. We're doing that right now. But if you look at the history of bull markets since 1950 up through 2020 at least, bull markets from trough to peak have averaged 4.29 years, right? And here, this prior bull market was 2.35 years. So, a little more than half, right? Also, the average gain of a bull market from trough to peak is 133.09%. Here it's 76%. So again, a little more than half the average. So this prior bull market has lasted a little more than half in duration and had a little more than half of the average gains of all bull markets historically, right? So that's kind of interest for the present situation, right? Because this is so borderline, right? This confirmed bear market here, you could, if you were measuring this on a closing price basis, you would consider this a correction, not a bear market. But on an intraday basis, we consider it a bear market. So it's so borderline that you could look at it from either perspective, right? And have an opinion based on that, right? So we'll talk about both perspectives in a minute. Okay, other things to consider though. So let's assume first this truly is a bear market, which it is on an intraday basis, right? What can we expect going forward? Okay, again, I mentioned bulls trough to peak, average 4.29 years. So far, we've seen 4.5 months. So that would indicate we're extremely early in the cycle, right? The shortest on record was 1.15 years. So if it turned around now, it would be the shortest bull market ever, right? Extremely unlikely, right? But anything's possible. The longest on record, 9.55 years, right? And that was leading up to the 2018, the post-financial crisis leading up to 2018. Okay, and the gains during those time periods from bulls from trough to peak, again, average 133.09%. The range is a positive 44.62 to a positive 341.05%. So far, we've seen a gain of 32.28%. So again, indicating that not only if it were to turn around now, it would be the shortest in history, but also even if it was longer than this, it would still be very short, and a low probability event that it would turn around in the near term. Okay. Similarly, bulls after indication to peak. So bulls after indication being June 27th, 2025, until the peak before a new bear market. Look at it from that perspective. Right? On average, they have lasted an additional 2.44 years. So far, it's only been 54 days. And the range has been a positive 6 days to a positive 7.44 years. So again, if it were to turn around now, it would be, it would not be the shortest turnaround in history. That has happened one time before in the lost decade leading up to the financial crisis. That did happen one time, so it wouldn't be the shortest. And if you look at it from a returns perspective, the average is an additional 52.53%. So far, we've seen 4.04%. The range is at a positive 2.09% to a positive 225.74%. So again, if it turned around now, it has happened one time before, right? But it would be a very extreme scenario, right? Because again, if you look at the averages, we're not even close to what the average would be historically since 1950, right? Okay, so those are things to consider. Other things to consider, right, that are, I believe, more pertinent now, because all of this says so far that we are very likely very early in the cycle and that we've got a long way to run, right? Other things to consider, though, are what happens in terms of corrections, the depth of corrections, the length of time before corrections occur, right, following a bear market trough. So if we believe this is a bear market trough, which we do, if you look at the distance between either a bear market trough or wolf market trough and the next peak, right? That's what I'm measuring here, right? The range is anywhere from just 1 day at the shortest to up to 5.62 years. So pretty broad swath there, right? Or spread. And the average is 1.14 years. Now, when it comes to this measurement, this happens to be one of the measurements, if we look at history, that tends to have a relatively normal distribution, right? Although there you have these two extremes, most of the corrections that follow a trough like there, they tend to cluster around this 1 year mark, the average of 1.14 years, right? So that being the case, right now we've seen 4.5 months, right? So most likely the next stage, looking at it from this perspective, is that we will have a continuation of positive returns for some time period before we need to start preparing for an additional correction of 10% plus, but not greater than 20%, right? That is the most likely potential scenario here. Okay. All right, other things to consider. Another thing that we look at from everything we've talked about so far is what we call a historical market type analysis, right? And another methodology or method that we use to analyze markets is probabilistic analysis. So one of the things that we do every single day is we have a list of various asset types, and those asset types are very similar to the list of assets that you saw over here, right, that we talked about earlier. Broad asset categories, and we measure whether those, we create what are called probability distribution curves for each one, and we determine whether each of these asset types are over or undervalued relative to their own history, right, and also relative to each other, so relative performance, right? And if we do that, and we do that probabilistic analysis, so as of this morning, if you looked at various types of stocks and bonds, stocks, for the most part, are hovering anywhere from fair value, near fair value, to slightly overvalued, right? So for us, if anybody that's a statistical nerd out there, that's anywhere from negative 0.5 standard deviations up to positive 1 standard deviation, and most of them are pretty close to 0, actually, right? They're in that area. Whereas bonds are looking slightly undervalued to near fair value. So slightly undervalued being anywhere from negative 1 standard deviation to positive 0.5 standard deviations, and if we're talking about pure statistical analysis. So basically what that means is bonds look a little cheaper than stocks, but nothing looks significantly, over or undervalued. Everything is relatively close to fair value. There's nothing extreme here, right? Okay. All right, so in summary, if we look at all those things together, okay, we saw the bear trough confirmed on April 7th of 2025, which is the same day it was indicated. So it troughed and it was indicated and turned around on exactly the same day. And we confirmed that on June 27th. All right. The bear market was confirmed on an intraday basis, but not on a closing price basis, right? Okay, that's interesting to consider. And again, the bull was confirmed on June 27th, and this was an extremely rapid recovery, if you look at history, how fast this recovered, right? So there's only, I think, one or possibly two other times historically that a bull recovery has occurred faster than this one, right, from a bear market. All right, so this was extremely rapid. So that begs the question, okay, because this is so borderline a bear market, right, should we think of this more of as a correction in a broader bull market, or should we think of this really as a true bear market reset, right? So let's think of it from both perspectives, right? If it's a true bear market reset, which we believe it is, and that's what it looks like based on the data, then everything I said so far makes perfect sense. We're very early in the cycle. You can be pretty dang positive on we've got a significant amount of growth to go before we have another bear market, right? If, however, you believe, this is so borderline, I don't know, is this really just more of a correction in the broader bull market that started on June or on October 13th of 2022, and this is like the second correction in this broader bull market, even if you look at it from that perspective, right, we would still be, looking at history, we would still be only roughly halfway, right, through the average bull market historically in terms of time and in terms of returns, right? Plus, if you look at the number of wolf markets, the number of corrections that occur before a new bear market occurs historically, typically the average is about 2.5, is between 2 and 3, and there have been as many as 5 corrections historically before you get a new bear market, right, historically as well. So even if you look at it from that perspective, we have very likely an extended period of positive returns to see going forward here before we get, at least before we get another bear market, right? And probably before we get another correction as well, right? So what does all this tell us? All right, so if we look at all that together, our outcome, our actions, so the stock market outlook, depending on which of those perspectives you look at, is neutral to positive. Positive being more likely, right? If you could zoom in a little bit more, Nick, that would be helpful. So what can you do as a result of that in terms of your overall portfolio allocation and cash deployment? Maintain a neutral to positive stance overall, right? So definitely not a negative one, right? You can overweight liability-driven investing and strategic asset allocation over and underweight opportunistic investing and selective or concentrated investing temporarily. And let me explain that a little bit for those who are not familiar with those different approaches. So when we look at the world of investment management, I'm going to give this like the ultra short version of this because many of you are familiar with this, some of you aren't. We talked about the different types of market environments, these 4 different types of market environments. They each have a certain type of investment method that tends to perform better or worse relative to the others inside of it. So for example, in bull markets, strategic asset allocation tends to perform the best. In bear markets, liability-driven investing tends to perform the best. In wolf markets, opportunistic investing tends to perform the best. And in eagle markets, selective or concentrated investing tends to perform the best. Right? We have whole sets of literature you can read on our website about this. We're going to be producing more of this over the coming months as well. So look out for that as it comes out. We'll probably be publishing on that subject. Okay, so just going back to what I was saying. Because of the fact that strategic asset allocation tends to do best in bull markets, and we believe we are in a bull market currently, and that bull market is very likely to extend in duration, strategic asset allocation should be your highest allocation. All right. That being said, because we have now are in a confirmed bull market, and we just came out of a bear, we're not, back here we were 100% go on strategic asset allocation, right? That's basically what our modeling told us to do, right? But because we've re-achieved that prior record, our algorithmic processes have now told us that it's time to have at least some allocation, even in our most flexible strategies, to liability-driven investing. So that's why we're saying allow some weighting to liability-driven investing here, which is basically bonds, in its simplest form, right? That's what we can call it, right? So higher stocks versus bonds, right? Underweighting to opportunistic and selective or concentrated. That is temporarily the case now, right? That will probably not be the case for very long because of the fact that we have, because of the fact of this year, this bear or correction trough to bull or wolf peak thing I talked about 1.14 years before you get another correction. We're now about 4.5 months out. As we approach that 1 year mark, we're going to be gradually increasing our allocation to opportunistic investing in preparation for a future correction, right? So you'll start to see that. So this will change over the coming months, most likely, barring anything crazy that happens in the markets, right? Other things to consider at a really granular level are if you look at the probabilistic analysis and the relative valuations of different types of assets. Right now, long-term U.S. Treasury bonds look the cheapest in terms of the asset class types out there, whereas emerging market stocks look the most expensive. Now, what is cheap, what is expensive? I mentioned here that basically all stocks and bonds are not too far away from fair value, right? Right. So even long-term U.S. Treasuries, which are the cheapest, are only they're only just slightly undervalued. They're not like a screaming buy or anything. And emerging market stocks, as the most expensive, are only slightly overvalued, so they're not a screaming sell either, right? So everything is relatively close, around that fair value range. No real big movements required there, right? Okay, so what can investors do in light of all this? If we go back over here, Mick. So let's start with income investors. All right, so for income investors, people that are actually taking withdrawals from their portfolio, maybe they're in retirement and they need the money, right, from their portfolio to supplement their income. You want to be neutral on your withdrawals. You want to be taking too much. You don't want to be taking too little. You want to do a personal cash flow analysis, determine what you need from your portfolio to supplement your Social Security, your pensions, and every other income source you have, and take exactly that amount, not more, not less, right? It's very simple, right? It's a relatively conservative approach, right? Assuming that we're not going too positive on the markets, right? The other thing that you could do now that we've re-achieved the prior records on this, so during this time period here, as the markets were declining, what we were advising some clients to do was to minimize with the withdrawals from their portfolio during that time period so that they could maximize the amount of their assets they had at work for them in the marketplace while the market was down. So anybody that was doing that, now that we've re-achieved prior records and are at records now or near them anyway, it would be a good place for anybody that needs to replenish their cash position in their bank accounts. This would not be a terrible time to do that, but replenish it up to the minimum level. It's not time to take a big, take all the gains off the table, because there's probably a lot more gains to be had here. It's just a matter of replenishing back to your minimum necessary cash level, only if necessary, right? Only if you went through that process that we recommended to some clients. And then for growth investors, again, very similar. We have, we're neutral on your systematic investments, so whatever you have available to systematically invest after you've covered all your expenses and your taxes, etc., that is the number that should be going in. You should not be trying to over aggressively deploy cash. You should not be trying to deploy any less, not too aggressive, not too conservative, neutral, right? Moderate deployment of cash into the marketplace. That being said, you should have no fear of cash deployment. As you accumulate cash, as you have earnings that come in excess of what your living expenses, your taxes, etc., are required to what is required to pay them. If you're in the accumulation phase of your investor life cycle, there should be no fear of cash deployment at this stage. It's not like we're late in the cycle where we need to build up a cash position in anticipation of any kind of significant drop. We're very likely nowhere close to that. All right, so there should be no fear of cash deployment. So as you have cash that piles up and it hasn't been systematically invested, to the extent that it exceeds the amount you need for a short-term liquidity fund, deploy that money into your diversified portfolio. All right, so that's effectively what people should be doing right now. Okay. Now that that's out of the way, now it's time for our quick commercial. So most of you know us already. For those that don't, so 4Thought Financial Group is an SEC registered investment advisor, and we're an independent firm. We have no affiliations with any larger organization, and which makes us, we believe, a little bit more unbiased and objective in working with our clientele. And we can do things the way that we believe are the best thing for our clients, right, and for the people we work with.